United, American, and Delta Airlines offer almost exactly the same product, not identical, but intentionally very similar. This is by design. When one eliminates change fees, the others follow. When one announces free Wi-Fi, the rest make the same announcement. When one raises baggage fees, they all do. They each offer similar legroom, snacks, lounges, and reliability. The large U.S. airlines are functioning in a classic oligopoly, where a small number of players dominate the market and strategically avoid aggressive competition with one another. In oligopolistic industries like this, it's often unwise for one company to differentiate itself significantly on product or price. Competing on price tends to be mutually harmful, leading to a race to the bottom that none of the airlines want. That's why prices between them remain broadly similar. It's alleged that these airlines even use algorithms to adjust and match fares, avoiding major undercutting. With product and pricing kept essentially the same, the only major avenue left for competition is in route network design. And here is where United stands out. Although, at first glance, the route maps of United, American, and Delta may look similar, closer examination reveals subtle but significant strategic differences. United, in particular, distinguishes itself by prioritizing depth of network, flying to more destinations, even if it means fewer flights per route and fewer overall passengers. A good example of this is United's Anchorage to Washington, D.C. route. On paper, this doesn't seem like a logical choice. D.C. is not a strong connecting hub for flights to Alaska, sitting 300-400 miles away close to the edge of the range for a 737 MAX 8. Operating flights at the edge of an aircraft's range often results in weight restrictions and increased fuel costs, harming profitability. But United launched the route anyway. They were likely betting on local demand, people in the D.C. area or in Alaska willing to pay extra for a non-stop option. The route has been renewed for the 2025 summer season, suggesting the gamble paid off. This reflects a broader pattern in United's strategy. They tend to be more risk-tolerant than Delta or American, especially when it comes to launching new routes. Rather than focusing on tried and true high-demand paths, they often bank on their ability to induce demand by offering unique, more convenient itineraries. For instance, United serves small or underappreciated U.S. cities like Pueblo, Colorado, and Devil's Lake, North Dakota year-round. They also fly to destinations like Edinburgh, Scotland, and Auckland, New Zealand, even during months when other airlines scale back. The same mindset applies internationally. United flies to 58 different long-haul international destinations, significantly more than Delta 41 or American 26. This includes not just key cities but second-tier or seasonal destinations where they see untapped potential. For example, while Delta and American both serve Auckland seasonally, United is the only airline with a non-stop to Christchurch, the largest city on New Zealand's South Island. This route wasn't just about capturing existing demand. It was about creating it, offering a convenient direct flight in hopes that more travelers would plan around it. United has done this before, with routes like Cape Town and Tahiti, which are primarily leisure-focused. Since leisure travelers are more flexible, United bets that the convenience of non-stop service can induce more demand. Launching such routes requires a tolerance for risk, especially when traffic data isn't sufficient to justify the route the way it might be for domestic flights. But if successful, United can lock up the market before competitors have a chance to react. This international strategy extends to their unique Pacific hub in Guam, which evolved after the COVID-19 pandemic disrupted Japanese tourism to the territory. Instead of winding down the Guam hub, United redeployed aircraft to turn Tokyo Narita into a mini-hub. From there, they launched narrow-body 737 routes to secondary Asian destinations like Cebu, Philippines, Kaohsiung, Taiwan, and Ulaanbaatar, Mongolia. These flights connect efficiently with United's U.S. long-haul arrivals, allowing United to offer the fastest itineraries between the U.S. and these cities, faster than connections through other airlines or alliances. In many cases, United becomes the only airline offering such routes entirely on its own metal, which can be a competitive advantage with USE-based travelers unfamiliar or uncomfortable with foreign carriers. Seeing success with Tokyo, United doubled down on the strategy by launching similar mini-hub operations in Hong Kong, offering connections to Bangkok and Ho Chi Minh City using long-haul aircraft. These flights use 787s, planes that could otherwise be serving profitable long-haul routes, which underscores how confident United must be in this bet. United's international strategy is also shaped by the weaknesses of its partners. For example, across the Atlantic, United operates a joint venture with the Lufthansa Group. While this partnership helps scale operations, it also means most of United's European connectivity depends on hubs in Frankfurt, Munich, and Zurich, cities that are deeper into Europe and less conveniently located for passengers traveling from the US. As a result, United supplements the partnership by flying non-stop to places Lufthansa doesn't serve well, especially destinations in southern and western Europe. This includes cities like Faro, Portugal, or Tenerife, Spain. United has even tried flying to more eastern destinations like Prague and Bergen. But these efforts didn't always succeed. Still, the routes that have stuck give United a distinct edge. In many of these cases, they're the only U.S. airline offering non-stop service, meaning they essentially own that market. This trend is spreading across the Pacific too. United is now the only U.S. airline with trans-Pacific flights to cities like Christchurch, Adelaide, Cebu, Manila, Kaohsiung, Osaka, and Ulaanbaatar, among others. These investments set United up exceptionally well as long-haul leisure travel from the U.S. continues to boom. In contrast, American Airlines takes a far more conservative approach. While they fly to a large number of destinations, they carry significantly more passengers by focusing on higher density, often domestic, routes. Their strategy isn't about pioneering new markets. It's about covering the essentials efficiently. In fact, American has more or less admitted this in recent investor presentations, stating plainly that their approach is to do what they need to. Ultimately, the competitive edge United seeks lies in its willingness to take risks, go long, and fly deep. Where others follow the data, United follows instinct, betting on routes with less certainty but higher potential. That strategy has increasingly paid off, allowing them to dominate in markets where competitors don't even fly and serve customers with options no other U.S. airline offers.